What's going on, everybody? Thank you so much for checking in. In this video, we're going to go over SPY, which is the S&P 500, and we're also going to go over our watch list, which is going to cover names like Apple, Tesla, NVDA, Google, and Alibaba. We're going to give you all the levels, including resistance and support points that you're going to need. That way you know exactly where we plan to take profits or cut losses and the strategies that we plan to use on each of these stocks. So let's go ahead and get started by first talking about SPY. We always like to start with the S&P 500 because it gives us a general idea of what the overall market is doing, and we like to always start with a large macro time frame, which is the daily time frame in this case, because we get the idea of where the overall chart lies. So right now, the S&P 500, or SPY in this case, which is the ETF, has managed to climb back above all of its healthy moving averages. We can see that we're trading above the 10, 20, 50-day, 100, and 200-day moving averages, which are all considered to be supports now that we're trading above them. So notice when we traded above them in the beginning of the year, the market kept rallying up. Here in this case, we have a period in which we dipped below them, but we were quick to come back up, and now we are trading back above them. So they can all be used as support points. Now, institutional investors and institutional traders, they're always paying attention to the 50-day moving average, which is this yellow line here. When we're trading above it on the daily time frame, we are considered to be leaning bullish. And when we're trading below it, selling picks up. As you can see here, when we broke below it, selling picked up for 3 days straight, and we're considered to be more bearish. And so now that we're above it, we are leaning more bullish. Let's talk about some levels to focus on for the next coming weeks. That way you know exactly how to trade and what resistance points to focus on. So first of all, let's focus on the hourly time frame here, in this case on SPY. We can see that our first resistance is going to be at 409.50. The reason that's 409.50 is because when we look back at the last week, we can see that on Friday, after we dipped below 412.75, we went up to a high of 409.50 and got rejected back down. So coming into this week, we need a break above 409.50 in order for us to move back to test the 412.75 level, hence why our next resistance is at 412.75. So although we are looking bullish on the daily chart, we still can't assume a bullish breakout until we break above 412.75, because that was the highest point and the strongest rejection that we've gotten in recent weeks. So above 412.75, then we will turn more bullish. We will pick up our calls, or we will long the market, and we will move towards a price target of 415. If we move above 415, then our next price target is going to be anywhere between 418 to 418.50. So if you've never watched our videos before, or if you're new to trading, what we do here is when we break above a resistance, we get into a long position or a call position, and then the next resistance points are going to be our price targets. So if this is our first price target, then we would take profits on half our position. That way we secure at least half at 415, and then we would move our stop loss up from below 412.75 to just below 415 if the market breaks above 415. And then if it does, and we have our stop loss just below 415, our next price target to take the remainder of our profits would be around 418 to 418.50. Now, say it breaks above 412.75, however, it comes back down, you can either set your stop loss just below 412.75 if you do get into a position, or you can set it just below 409.50, which is going to be the first resistance in focus. Now, if you are bearish on the market, or if you're looking for a downside move, you're going to need a break below 405.70 in order for the market to sell off. Now, the reason why the support is 405.70 is because we can see that last week the market, or SPY in this case, came down to around 405.70 and formed a double bottom pattern and eventually moved back up. So a double bottom pattern is a pattern, it's a bullish pattern in which a stock bounces at the same support point twice and then it continues its rally up. We can see that we bounced here and we bounced here right around 405.70, and then we continued moving up. So if we do break above that 409.50 resistance this week, then we are going to push higher. So how are we going to push up or down this week? What are going to be some catalysts to focus on? Last week we had the unemployment report. So last week the biggest focus was unemployment. We had our unemployment come in at 3.5% on Friday, and Friday was a market closure day. So markets were observing Good Friday, and therefore the market wasn't open. So we're going to see the reaction of the market in this coming week at the open. And the unemployment rate is at 3.5%, which is going to be a decline from the month previous. So we hit a a total of 3.6% in February, and then in March we dropped back to 3.5%. So this challenges the narrative that we are in a recession. So remember, a recession involves three things. One is a high unemployment rate. Two is negative GDP quarters, back-to-back GDP quarters. And finally, a slowdown in retail sales. Now, you can see that in the 2008-2009 recession, unemployment reached a high of about 9.4%, which is not nearly where we're at right now. In fact, we are at a historic low when it comes to unemployment. And even if we're looking at job openings, we can see that we have about 10 million in job openings available still, which is a phenomenal number. And it shows that our economy is staying resilient even through the higher interest rates and even through inflation. So those are all good signs for us when we're looking at things from the economy perspective or from the unemployment perspective. Now this week things shift a little bit. We are going to move towards the CPI report. We have inflation data ahead of us. So inflation data has been cooling down for the last few months, and inflation has been the number one driver of our market up and down. So CPI report and PPI reports are expected. So those are the things that are expected to move us up or down. If the CPI report comes in higher than expected, then we may see the markets move down. And it won't move down necessarily because the CPI report came in higher than expected. It may move down because if a CPI report comes in higher than expected, then the Federal Reserve is forced to raise interest rates, which will have a negative effect on the stock market because it has a negative effect on company income. So, and finally, last but not least, this week we're also expecting retail sales data. Now, retail sales data has been slowing down. It slowed down in February, so we're going to be looking forward to seeing what it did in March. Consensus is it will slow down. However, it really just depends on the consumer. So retail sales data is important because it gives us the frontline number of how consumers are feeling. Obviously, consumers are the ones that are buying retail. So if that's slowing down, then the consumer is starting to cut back on spending. Now, moving on to our watch list. Our watch list is going to include these names, and we're going to start off with Alibaba. The reason why we have this bullish flag pattern pulled up here is because we want to show you what a bullish flag breakout looks like, and we can see that Alibaba has a very similar pattern developing. It has this large move up, and then it's consolidating, and it got a boost of buyers on Friday. So last week the market pulled back. However, Chinese stocks like Alibaba managed to move up on Friday, and that is a good sign for Chinese names, especially like Alibaba, because Alibaba actually gapped up a few weeks ago after announcing that they're going to be spinning off their business into 5 different sectors or 5 different businesses, all under the name Baba, and they will be ran by different CEOs. Think how Google did with Google and YouTube. Google still owns YouTube, or Alphabet owns Google and YouTube, but they each have their own CEO. And so in this case, Alibaba is doing the same thing. Buyers have really liked this. You can see that they have been relentless. And when Alibaba came down to its support, it managed to bounce up. So let's talk about some levels to focus on as you trade Alibaba for the next couple weeks. First of all, we want to talk about the 97.25 support because that was the lowest point that it reached during its consolidation after its gap up. So it gapped up to around 92, and then it continued to rise up, reached a high of 105.05, which is why that's our main resistance and focus. Came down to a low of 97.25. So if it breaks below 97.25, then it's starting to dip into more bearish territory and it can sell off towards 92. However, we wouldn't short this stock and we wouldn't play puts on the stock unless it breaks below 92. At that point, we would be looking to play a gap fill down towards the 88 level. However, if it stays above 97.25, then we are going to remain bullish on it. Our stop loss would be just below 97.25, and our first price target above 105.05 is going to be around 108 to 109. So that's going to be our first, and that's not a too aggressive of a price target. This is just a start. However, we are expecting Alibaba to continue pushing as long as it holds this 97.25 support. Above 108.70, it can push higher, and we will talk about price targets sometime in our next videos in the next couple weeks. Now, the next stock on our watch list is going to be Google. Google had a phenomenal upside breakout last week, and we can see that volume accompanied that breakout, which makes them very attractive to us. Google's daily candles are also all trading above the 10, 20, 50, 100, and 200-day moving averages, which makes them a very attractive stock to buy and hold, swing trade, or even position trade. Here are some levels that we're focused on for Google. Now, Google had its breakout and it came down to 105.80 and it bounced, which means 105.80 is going to be our main support and focus going into the weeks ahead. If it breaks below 105.80, it's not really a big deal. As long as it holds above 100, that is going to be our most attractive area in which we could buy it. Our stop loss or our short position would start below 99.70. So if Google breaks below that point, then we would consider shorting the stock or playing a put towards 96. However, we are leaning more bullish on Google since that big breakout was accompanied with strong volume and strong relative strength. And so we are bullish on Google strongly above 105.80. Our next breakout target is going to be 109.20. Above that point, our price targets are going to be 112 and 114 to 115. So that's going to be our profit taking points. The next stock on our watch list is going to be NVDA. Now, NVDA, for the first time in about 3 weeks, the stock has moved below its 10-day moving average once again. We can see that every time the stock has moved below that point, buyers stepped in and pushed the stock higher. So in this case, this week, we're going to be focused on if the stock can manage to stay above the 10-day moving average. So can it make it back above this blue line here, which is on the daily chart? Or is it going to move down towards its 20-day moving average? Now, in order to do that, it's better to look at the shorter term time frame so we can see market levels and we can see exactly where the stock has support and resistance points. So the stock's primary support going into this week is going to be 263.80. If it moves below that level, it can fall to 253.85. However, we wouldn't consider shorting or playing puts on this stock until it breaks below 245. If you decide to short the stock or play a put on the stock here below the 263.80 point, it's completely fine, but it's just higher risk, so a smaller position is recommended. But if it breaks below 245, then the stock will move back into this consolidation range. You can see that the stock consolidated in this range for about 2 to 3 weeks before finally getting enough momentum to break out. So you can imagine that if the stock breaks below 245, then all those buyers that bought it up are going to probably let go of their position and they're going to bring it back towards 223 to 233, which is a pretty aggressive price target from where it's at right now. If you are bullish on NVIDIA, then you want to focus on that daily chart. You need the stock to find buyers just like it did here at the 20-day moving average, enough buyers to push it back above the 10-day moving average. Now keep in mind, anytime a stock deters too far away from a 50-day or the 100-day moving average, eventually it finds a way to correct itself back down. Exactly what happened here. You can see that the stock started drifting too far away from this yellow line, which is the 50-day moving average, and it found a way to correct itself back down. So in this case, NVIDIA is likely going to do that soon. So if you are betting bullishly on this stock, it would be considerate of you to take on smaller position sizes because it is unlikely that the stock can continue its rally before having a strong correction back down. The next stock on our watch list is going to be Tesla. Now, Tesla last week has actually had a very bad week in comparison to the rest of the market. The stock pulled back severely after releasing their numbers for vehicle delivery. So they released the numbers on Sunday, and then the stock started moving down since that numbers release. So Tesla is trading back below its 10, 20, and 50-day moving averages. In fact, it's even trading below the 200-day moving average. So if you are looking for moving average support and resistance points, the first support you have in place here is the 100-day moving average. But let's switch gears and talk about Tesla on a shorter term time frame so we know exactly which levels to watch. Now, Tesla's levels are a little crowded, for lack of better words, because there are so many supports and resistance points being made because the stock is trading in such a tight range, which makes them to be not one of the cleanest setups on our watch list, but still we like to cover this one because it usually gives really good profits if you catch the right side. So if you are bullish on Tesla, then you are not doing so good right now. However, a bullish position is possible on this pullback only if Tesla can hold the 180 support. And why do we say the 180 support? That is because that's exactly where Tesla bounced last week when it came down to a low of 180, we can see that buyers stepped in at 180 and they decided to buy the stock up. So if you get into a bullish position on Tesla, then you would want a stop loss just below 180, but the stock wouldn't be considered fully bullish or wouldn't be considered back in a bullish trend until it moves back above 208. That would be the most attractive level in which bulls are likely going to step in and buy up the stock towards 212 to 217. Now, if the stock breaks below 180, then unfortunately it's bad news for the buyers, and the stock is likely to sell off to retest 176, and below 176 it could be a very easy move down back to 163 to 165. So just keep that in mind. If the stock breaks below 180, then it will turn severely bearish. The last and final stock on our watch list is going to be Apple. Now let's take a look at Apple on the daily chart to see what it's doing. We can see that Apple is bouncing once again off of its 10-day moving average. Since the stock has gone on this breakout, it has held the 10-day moving average very well. You can see that it came down to it and got buyers, came down to it, buyers stepped in once again. And so now the question is Apple going to bounce once again, and is it going to move higher from here? Now, Apple is considered to be slightly overbought here, so a pullback is necessary, but we can't just assume a pullback is coming. We have to look at the levels, and we have to just play whatever the market gives, because you never know how long a stock can just rally without stopping before it gives us a pullback. So let's talk about some levels to focus on for Apple. So Apple here in this case has a new consolidation range. You can see that Apple here consolidated for about 3 to 4 weeks between the high of 158 or so and a low of 143.50. So that's our first consolidation range to focus on. But since Apple broke above that range, you can see that it broke above it, came down to 156 and bounced. So if you are bullish on the stock, then you would want the stock to stay above 156 in order to hold its consolidation range. If it comes down to 156 and breaks below it, then it will move back into this consolidation range, and it's likely going to sell off towards 150. And if it breaks 150, it can even move down to 144 or 143. However, the stock is currently holding a bullish trend. The safest support to focus on, if you don't want to risk it all the way to 156, is going to be 161.80. If the stock can hold that point, then it has a chance to move back towards 167. If it breaks above 167, then the stock has a price target of around 170 to 171, and that is a very aggressive price target. So before we leave you guys off, we just want to mention that this week starts the financial earnings. So earnings season is always kicked off with financial sector. And remember that the banking sector and the financial sector has suffered severely after the failure of the Silicon Valley Bank. And so many traders and investors are going to be paying close attention to what banks like JP Morgan, Wells Fargo, and many other banks are going to be reporting the next week or the next even 2 weeks. So if you are a trader or investor, make sure you're paying close attention to the financial sector. We want to make sure that our banks are doing well because they are the foundation of our economy. So thank you guys so much for checking in. We appreciate your time. Don't forget to subscribe and like.